And the answer is, yeah, it's risky to do everything in life. Life is risky, but what's the most risky thing is not trying to do the things that you want to do. Because if you don't try, you're definitely not going to get whatever it is that your dream life is.
Hi, everybody. This is Luiz Morales. Welcome back to the Morales Group Show. This is episode number 87. Today, we've got a very special guest. His name is Jeff Holst. He owns approximately 300 units here in the United States, an investor, somebody that's obviously very seasoned and doing real estate at the high volume. Welcome to the show, Jeff. How are you?
I am well. Thank you very much for having me.
Before we get started with the interview, I just want to remind our viewers, if you've enjoyed some of our previous content, make sure to hit that subscribe button. And then if you feel that any of your friends, family, neighbors might find value, feel free to hit that share button and share it with a friend. So Jeff, I just want to start off just by saying, who is Jeff Holst and how did you get involved in this crazy thing called real estate?
That's a big question. So I'll start with the second part. How did I get involved in real estate? I always was a little bit interested in real estate. My parents had some rentals, 3 or 4, when I was growing up. And I was kind of a weird kid, so I would sneak out of my room late at night and go watch like late night infomercials that were talking about how to buy real estate with no money down. And so even before I could drive, I remember riding around in the car and looking at buildings and going, oh, I hope I own that someday. So I was always kind of a little geeky on real estate. As far as who I am, that's a broad question. That's really hard to answer. I like to think of myself as a person who does interesting things whenever possible and is living the very best possible version of my life. Now, obviously, I'm not perfect at that, but I try to lean into, really living well. And that's, there's charitable parts of that. And there's also, the buying back your time and having the freedom to do the things that are important to you and that kind of stuff.
How old were you when you bought your first property and what did that early chapter of your life look like?
Yeah, so the first house I ever bought was just like to live in when I was about 19 or 20. But I didn't actually start investing in real estate until I was in law school. I did a flip. So it was around 2006. I was probably in my mid 20s at the time. We did one flip then, and then I didn't do anything again until 2011 when I was about 31 or 32 years old, somewhere around there. That's when I really started focusing down on investing.
Okay, good. So you got in the market at a good time then, basically.
Yeah, I wish I could say I was a genius and just knew it was a good time, but it was mostly luck. I feel like everyone, I thought, I'm going to invest in real estate later. I'm going to do it when I have enough money, when I have enough time. It was someday I'm going to do it kind of thing. And then I went through this challenging period of time and I realized that not everyone has whenever and someday may never come. So I just was like, hey, I'm going to go ahead and start doing this now. And I was a bankruptcy attorney, so I knew the market was bad. I knew that the market had crashed. I'd seen a lot of people lose their life savings in real estate. And I thought, it's got to come back. So I guess I had a little bit of level of confidence that we were at a good point to buy as well.
How did you overcome the fear? Because I know for a lot of people, there was shadow inventory potentially coming on the marketplace. Some people were thinking that the market would just keep dropping. I bought my first one in 2010, very close to yours. My philosophy was I didn't care if it dropped more because it made sense. What about for you? Was there any fear there in terms of jumping into the marketplace, or how did you kind of overcome that?
Yeah, there were some. I feel like if you don't lean into fear once in a while, you never really accomplish anything. So one of my, fundamental tenets is not to run away from fear, but to face it. Did I think that, the market might keep falling? Sure. I thought there was a possibility, but the first deal I did was a $30,000 condo that had been 120,000, 3 years earlier. And it was a bank-owned foreclosure and we were paying cash for it. So it was kind of like, it didn't really matter because I didn't think rents were going to go down that much. They weren't really falling already. They'd been pretty stable throughout the crash. And I didn't really see any reason why a decent condo in a decent area was going to collect less rent than what we were collecting at the time. So, and again, with no debt on it, it was, it was kind of a no-brainer at that point. So
it's very low risk, basically. You bought it in cash and it's just there's not much risk to that when you're buying something at
Yeah,
$30,000.
I mean, it seems that way now. Of course, it was terrifying at the time. My wife said to me, if we lose this money, then we're never investing in real estate again. And fortunately, we didn't lose the money. We still own the condo, and it's probably worth 150,000 now or something. And we actually split it with another partner, my friend. Who I'd gone to law school with him, and I just, he knew the area a lot better than I did, and he thought it was a good deal, and I trusted his opinion to a large degree. And also, I didn't have enough money to do it on my own. So I had just come through a personal bankruptcy myself, and I'd saved up about $20,000. And so putting $15,000 down on a $30,000 condo to buy half of it for cash was pretty much everything I owned at that point. And we didn't have the option of financing. I didn't have any credit to go with not having any money. So
It was basically a stretch for you at that time.
oh yeah.
At what point did you transition into larger buildings? Like, meaning, like, what was the progression? Was it like small condo, small condo, small condo, big apartment, or at what point?
Yeah, it was so we did 2 or 3 condos, and then we did a couple of duplexes, and then we started doing single families at that point. So we did that from 2011 to about 2017. So about 6 years, somewhere in the low 50s is number of units when 2017 rolled around. I was working for a smaller company that was getting bought out by a bigger company, and they offered me a job at this big corporation. And I was like, no, I don't want to do that. So I took a buyout, and I thought, well, I'll figure it out. I had a 6-month severance. So I figured I had 6 months to figure it out. And I just never went back to work after that. And that's really when I transitioned into the larger deals. That was spring of 2017. I did a burr, like I bought a duplex and fixed it up and renovated it, got the money out of it. And then thought I should buy something bigger. So I went looking for a 10 to 20 unit building, and ended up finding a 12 unit building that my dad and I bought together in the fall of 17. And then my partner from that first condo actually got, I think, maybe even a little jealous, because we had been talking about doing that for a while, and immediately found a 19 unit. So a month later, we bought a 19 unit. And then from there, it was just sort of off to the races. We started selling houses and 1031ing into bigger deals. So we did a 32 unit in the spring of 18. And then not that long after that, we did a 41 unit, say maybe 3-4 months after that one. So
how did you go about finding this first big apartment? Was it just something that was publicly listed on the MLS, or was it something more like direct to owner type of
yeah, the 12 unit I actually found on LoopNet. And I know people say, LoopNet's like where deals go to die, and it's not good deals, but it worked out fine for me. In fact, I just sold it 2-3 months ago we paid $635,000 when we bought it, and we just sold it for $1,150,000. So 3 years, basically doubling the value of it. Now, granted, we did some renovation and put some money in during that time, but we did almost all the renovation out of cash flow. So we really didn't put a lot of cash in, and, we got a pretty good check at close. So yeah, I mean, it was just straight up, like, partly the rents have been up since 2017. So, again, good timing in the market, right, to be buying at that time. But part of it was just like, I was pretty confident from my other real estate that those rents could come up a significant amount. It was, I think, in that 10 to like 30 unit number, there's a lot of sort of mom and pop smaller operators that really don't keep up with rising rents the way they should. Then the guy I bought this one from, he had that property, and that was his biggest property, and he had a few duplexes. All of his properties were a little bit below market. In fact, I've since bought a couple of duplexes from him, and he's super happy because he's had them for a long time and he gets a good return. But I come in and renovate and fix them up and get the rents to where they should be, and then I'm super happy too. So
sounds like it works out for all of you guys. What do you typically look for when you're buying these properties? Are you like looking for a certain percentage below market value? Are you looking for something that has the low market value rents where you can increase them?
Yeah, so I am looking for something that has a value add element to it. So I want to be able to see that I can increase the income or or reduce the expenses, preferably both, but the income is more important to me than the expenses. I think a lot of people, recognizing that net operating income is just your income minus your expenses. If you lower your expenses, you get a higher NOI, but it's a lot easier to raise rents than it is to cut expenses. Most people are actually pretty good at keeping their expenses in line. That's not always the case. Sometimes you see someone who's paying really, exorbitant fees for stuff, but even still, you can only trim so far. You might reduce your expenses by 5 or 10% and feel like that's really, really good. Where if you raise the rents on a building we bought this building earlier this year, a 16-unit building, the average rent was $550. And we knew the market rents were, $800. So if you can raise $250 on a $550 thing, you're talking about a full 50% increase in value, literally just by going in and doing that. And so that's really what I'm looking for, is things where I can really see a clear path to a higher net operating income. I care about that more than what the going in cap rates are and stuff. I really just want to see what's it going to look like when I'm done with it, and what is it going to take me to get there.
Is the eventual goal to transition the 20, 30 units into 100 units, 200 type of unit apartments, or are you pretty comfortable playing in the 10 to 30 unit range?
Yeah, I've thought about that a lot. I mean, from a vanity perspective, it sounds cool to have 100-unit buildings, 200-unit buildings, but the truth is the stuff I'm buying have better returns. The cap rates are higher and compressing faster, so you're getting more of an upswing. And I think they're really predictable, and I really understand that market. So I'm not going to stop doing those. But if you were going to buy like everywhere in the country, you wanted 1,000, 2,000, 3,000 units, you kind of have to go to bigger ones. Part of the reason what we're doing works is because there's not that many people that compete against us. And the reason there's not that many people that compete against us in our market is you have to have good management in place. You have to have good contractors. And you can't have like a single manager like you can at a 100-unit building. You can have on-site staff and stuff. We don't do that. So I feel like for us, it works really well. Not saying I'll never do anything bigger, but right now I'm just going to kind of do what we're doing. So
which markets are you investing in, just out of curiosity?
Yeah, so I invest, I'm a big fan of investing in markets, so I'm from Michigan and I invest in Michigan. I live in Tennessee. I invest in Tennessee. I mean, that's literally how the strategy is. Now, there are like things that you can look at. Markets with declining population, probably not a great market, even if you happen to live there. So I do think there's, you have to think about those demographics. Like, is there an increase of jobs? What's the employment growth? What's the population growth? But fortunately, Tennessee, in particular, Chattanooga, where I am, those numbers are really good. So it's not, it's easy to invest here.
But what about Michigan? Is it increasing in population as well too? Or
Yeah, so the western side of Michigan has a pretty good job and population growth. The eastern side, it depends on where it is. In the more rural areas, same thing. It depends on where it is. So it's a little bit trickier, but we invest in sort of middle tier suburbs outside of the city of Detroit, and they have pretty stable job growth and they have reasonable population stability. So it's a little bit trickier than here, where it seems like everything goes up every day. Like every time I turn around, the rents are going up. Every time I turn around, the values are going up. In Detroit, it can be market more, neighborhood specific and stuff like that.
But what about, where would somebody go if they want to see the population or the job growth? Like, what type of data would somebody look for?
Yeah, so there's census data that tells you this stuff, right? But that's only once every 10 years. I actually really like something that I don't know very many people use. Is I call it the Uhaul metric. But basically, I look at the Uhaul reports because they actually publish these like quarterly, and they say this state has the most influxes of new Uhaul trucks. And like one thing you can do is literally just call like the local Uhaul places, and if it's really cheap to rent a Uhaul, then it's probably a good market because they have a lot of U-Hauls and they're trying to get them out of the market. So if you can rent a U-Haul super cheap to go to Michigan from Tennessee, then Tennessee's better than Michigan. Because if you rent one in Michigan to go here in 2008, 2009, when everyone was leaving Michigan to come to Tennessee because of the economy crashing, the auto companies closing down and stuff, it was very expensive to rent a truck in Michigan. It was super cheap in Tennessee. So I know that's not really scientific, but it actually works pretty well, because if people are renting vehicles and dropping them off in their new state, then population's moving in that direction. So
That's actually interesting. I'd never heard of the U-Haul report. As it relates to the actual buildings, are you buying in A class, B class, C class? What are these buildings
yeah,
typically look
mostly
like?
B and C class. I mean, we have done a little bit in the A class, but it's a little bit more pricey and it's a little bit trickier to get the right numbers to work the way our model is. But the sweet spot for us seems to be like the C plus building in a B neighborhood. So we can kind of fix it up and move it from C to B. If you can do that, then it's like gold, because you get a lower cap rate on the exit than you had on the entrance, and you get better rents at the same time. And then you're in a good market too. The B markets are really nice. So
You mind me asking what the cap rates look like for? I know in California the cap rates are like 4.5, even 5.
yeah.
That's like really good out here.
Yeah, ours are a bit higher than that. But we're seeing, where like 4 or 5 years ago things were 8 caps, 9 caps, some places. That's all compressed down to like, mid sixes, low sevens in the kind of stuff I'm doing. C might be a little bit higher, B might be a little bit lower, but it's still in that 6 to 7 range. The A stuff is in the low fives or maybe even high fours. But yeah, we stick in that. If we can get a 6.5 or 7 cap, we feel pretty good about it, especially with the cost of borrowing being so low. Because really what matters more than your cap rate is the spread on the financing, right? If you can borrow for 3%, then you can justify 4% cap rates all day long because you make 1% on the bank's money. So
How are you financing these deals? I know that some people struggle whenever it's a value add. For our viewers, if you don't know what a value add, typically it means something that you can increase the value either by making the building better or increasing the rent. How do you finance most of these buildings going in through it? And are you refinancing and pulling most of your money out at some point? And do you ever structure deals creatively with other joint venture partners or even other investors?
yes, we do. So how we structure them financing wise is mostly regional banks on the going in stuff, because they're not super stable. So we can usually get like basically where they'll come in and do an appraisal and say this is the as is appraisal and here's our stabilized appraisal. We'll get that, and they'll oftentimes we can even finance some of the construction that way. It might have some period of interest only. It's kind of like a modified bridge loan, but we get much better terms by having strong relationships with these local banks. And they typically want us to keep it with them. So the deal is a lot of times they'll finance based on the idea that we're going to keep it for, 3 to 5 years. So there may be a prepayment penalty or something. So it's not an immediate refinance to pull out your cash every time. But sometimes we're able to do that. So like we did a 41 unit couple of years ago where we bought it, and 18 months later we refinanced it, pulled out more than what we had put in. We still own it. Cash flows like crazy. It's a great deal. So I love doing those. And that's always sort of the goal, but it doesn't always work out exactly that way. But we have been pretty successful in the last few years of refinancing projects after 18 to 24 months and pulling out most or all of the money. Kind of the new strategy is to go to the 30-year Fannie and Freddie stuff and non-recourse type debt, because I think, we're getting so much on the balance sheet that the local banks are starting to get a little queasy. So if we can roll some of that stuff off into non-recourse, then it doesn't scare the banks anymore. They don't care anymore. So we've done that successfully once, and we have a few more that we're looking at now. So
What challenges have you had to overcome, like investing in real estate, like whether it's mindset, health, just any type of challenges that you had?
yeah, so I alluded to this earlier, but I didn't get started right away. I just figured I'd do it later. And then in 2008, I was diagnosed with leukemia, and it forced me into personal bankruptcy. So I was a bankruptcy attorney, and then I went bankrupt, and I was in a situation where I had no money and no credit. And so the idea of getting into real estate in the middle of a recession, this is 2010 now, just filed bankruptcy, no money, no credit, not sure I'm going to live. In one way, that was very helpful to me, because it was like, well, what do I have to lose? Like, give it a try and see what happens. But on another way, it would have been really easy just to be like, there's no solution to this. I'm just going to walk away. But I just kind of went, well, I have to figure it out. So first we bought that property for cash, and then we were out of money. And then it was like, okay, what do we do now? And so we had to get really creative, and we kind of came up with some hard money type options to do some flips and make some money that way. And We got a few more properties. We were able to get a private lender that would loan us money on those free and clear properties, and we'd use that. And then we just kept trying to just sort of figure it out as we went. So in a way, the biggest obstacle I had was also probably the biggest motivator. So it helped, right? But it really came down to having faith in your ability to sort through the situation you're in. And then also like asking yourself the right questions. Kiyosaki talks about this a lot. He talks about how you shouldn't say to yourself, I can't do it. You should say, how can I do it? Right. And I think that, I'd read Kiyosaki's book when I was right out of high school when it first came out, and I reread it again right after I got sick. And I think that question actually really helped me. It was like, no, how can I do this? How do I figure this out? And as long as I kept approaching it from that perspective, it wasn't so hard.
Besides Kiyosaki, who else have you looked at for real estate advice?
Everyone. Right. I've read a ton of books. So I've listened to tons and tons of podcasts. Now I've been on tons myself, but podcasting has been great, but also books. Like when I wanted to transition to multifamily, I read Brian Murray's book, Crushing It in Apartments and Commercial Real Estate. And that was a game changer for me. It explained to me how cap rates worked and how you could create forced appreciation. And of course, he's just written a book with Brandon Turner, which is probably also great. I haven't read that one yet, but I've read, just like whatever I could get my hands on book wise. There's a book by Larry Loftus called Investing in Duplexes, Triplexes, and Quads. That was great when I was first starting out because it really showed you a path where you could, a repeatable strategy on how you can make strategic investments and how it really could be done in a relatively short period of time. But I even bought like Carlton Sheets's No Money Down course when I was in college and, had it on CD and I'd listen to it while I was driving around in my car, stuff like that. So whatever I could do to absorb real estate knowledge really was a big part. And then the last few years prior to COVID, it was all about going to conferences and meeting people that were doing the things that I wanted to do or was doing. And then post COVID, I'm just now starting to get in that back into conference world, but it's not quite the same as it was before we had the shutdown.
But what about your personal strategy? Are you more of a buy and hold type of guy, or do you flip as well too? Or does it just kind of depend on the actual deal?
Yeah, it does depend a little bit, but I prefer not to sell. So I told you I sold my 12 unit. That's the only apartment building I've ever sold. The rest of them we've always kept. And I do flip occasionally, or I might sell like single families to buy an apartment complex, right? Just do a 1031 and do that. Even the 12 unit that I sold, I 1031 into a retail space. We bought a 30,000 square foot shopping center. And that was really just about diversifying and also about someone offering me a price for my building that I thought was higher than what I really felt was reasonable. But now in retrospect, 6 months later, I'm like, wow, I should have kept it. I probably would have gotten more now. The market's so strong. It's just crazy, but that's all right. I bought something else with it and that thing's gone up as well. So
I love 1031 exchanges, by the way, as well too. That's my actual strategy. Like I'll buy single families and I'll exchange them into larger buildings as well too, just because you defer the taxes on it.
Yeah. And I really don't like taxes
what
at
about
all.
Same here. Do you do cost segregation studies on your buildings as well too?
Yeah, I do, as long as it's above a certain purchase price. So like if I'm buying a single family or something, probably not, but about $500,000 seems to be the sweet spot. You can get away with a little bit less and it might make sense. Depends on what you're paying for the study, right? So the real trade-off is like, what's the cost of the study versus how much tax savings are you going to get in the first year? I just did my taxes for 2020 and had a pretty large carry forward loss. So I paid zero tax for like the third year in a row since I discovered cost segregations and bonus depreciation. So yeah, I am a big fan of those. It's one of the greatest, I think, strategies and maybe one of the least appreciated. My cost seg guy told me that something like only 14% of multifamily owners are doing cost segregations, which is just shocking. It's shocking, right? Because if you're buying 100 units, 200 units, 300 units, and you're not doing a cost segregation, you're just throwing money away as far as I can tell. So
I found out about it in a Robert Kiyosaki book. It talked about the tax strategies or something like that. I forgot the name of the book, or Secrets of the Real Estate or something like that.
Yeah, well, so I found out about it from Tom Wheelwright, who's
Yeah.
Robert Kiyosaki's CPA, in the book Tax Free Wealth. And I saw him do a presentation on them, and I went, I have to learn about these.
Yeah.
And I got so geeked out about it, I went and made friends with a guy who runs a cost segregation company, and then talked him into doing a sort of referral program so I could tell other people about it and get paid for telling them. So feel free to reach out to me if you want that info. But yeah, it's amazing. I mean, cost seg is just fantastic. So
I learned about it because whenever I've struggled with something, I try to read a book that helps me with it. Meaning that book, I forgot the name of the book, but it was by Tom Wheelwright as well too. And at that time, I was paying a lot of money in taxes, and then that book actually helped me pay $0 in federal taxes as well too. And that was one of the things that I'm like, why didn't my accountant tell me about this? Like, why didn't I know about this?
And the thing is, I think the accountants, they don't always understand all this stuff. I mean, they're not real estate investors. And, this is one of the brilliant parts about Tom Wheelwright's book, is that he kind of explains what the idea behind the tax code is, as opposed to what the specific examples are, and kind of gives you the questions to ask your CPA. Because it's not that your accountant or CPA doesn't want you to get the best possible deal. They just may not know. And if you ask the right questions, they're like, oh, I'm going to go look at this. And that's what happened with me. The first time I did a cost seg, I called my CPA up and I said, hey, I heard about this thing, I want to do it. And he was like, I don't know what you're talking about. Like, what do you mean? And I was like, well, we got to figure this out. And then we did. And that first the 12 unit actually was the first cost seg we did, and we got $120,000 write-off in the first year. The $120,000 just disappears in income, and it doesn't cost you anything. It's depreciation is always a non-cash loss. So it's like the best kind of loss. It's the one that, saves you money and costs you nothing.
That's what I told my dad, because my dad actually lost money on a property. I'm like, look, that's an actual loss. This is a paper loss, meaning it doesn't cost you anything. What about like negotiation tips? Do you have any negotiation tips, like while you're maybe acquiring some of these assets, or how you're able to find good opportunities, or how you're able to see value maybe where others don't see value?
Yeah, so I mean, part of that's just about being creative. One of the things I think I'm pretty good at is simplifying complicated things to explain it to people in a way that makes them feel comfortable with it. And so a lot of times when you're buying something, if you want to do something a little bit different than what everyone else is doing, it scares people away. So if you can really, really get clear on why you're doing it a certain way, and it could be something like a 1031. I've had sellers go, oh, I can't, or buyers go, I can't buy from you because it says in here you're going to use a 1031. And it's like, you have to put that on the closing. But if people don't understand what it is, that freaks them out, right? They're like, oh, is that going to hurt me in some way or whatever? And of course it doesn't, but you have to be able to really get clear on what it is you're doing and why. And then also really understand how it's going to impact the other person. Because it's like, if you're putting together a deal, right? You're maybe say you're going to syndicate or raise money or something like that, or you're just going to ask someone to loan you money. You really got to understand how it looks from their side, and be able to really clearly articulate why that's good for them. And I think when you're negotiating, that's the trick. It's like, I've read lots of books on negotiation, starting with like getting to yes and stuff. And those are okay. I mean, Chris Voss's book is pretty good, Never Split the Difference. But really, if you really want to come down to it, I think the trick is knowing how to present the information in a way that's beneficial to the person you're negotiating with, so that they feel like, hey, we're doing this as a team. We're getting together and we're working on a solution that's good for both of us.
I agree with that 100%. Because obviously a lot of people are more focused on themselves, like what benefits me versus what benefits me, but what also benefits the other party as well too. What about any tips on finding a good deal? Meaning, like if somebody wants to go about finding a good opportunity, maybe like the 42 unit that you bought.
I mean, a lot of it's been relationship based for us. So it's all about networking and telling people that we're in this market. And, that's one of the reasons I do my own show and I go on other people's shows, is because I want people to think of me. Like, someone sees me on your show and then they happen to run across a deal in Chattanooga, they're probably going to call me. They're not going to call some random person they've never heard of and say, hey, what do you think about this deal, right? So a lot of it is that. It's just getting out there and putting yourself out there and exposing yourself to deals, because the deals are out there, and it's also not being afraid to pay brokers and stuff. Like, a lot of people are like, I need to go like, mail apartment owners myself and try to be a wholesaler or something. That's fine if you have time to do it and energy to do it. But I mean, I'm a real estate agent and I'll still give them 100% of the commission if they bring me a good deal, because I would rather get the good deal than worry about getting, an extra point off their commission or something.
Not only that, but it's relationship based. I mean, meaning they have options in terms of other investors that they could sell to, and obviously, the better you treat them, the better. Any tips on raising money? Have you ever raised money?
Yeah, sure. So with raising money, the trick is, of course, it's actually very similar to what I was saying about negotiating. Like when you're presenting whatever you're proposing, you want to make it so that when a potential investor looks at it, that they're very comfortable with what you're saying, that you're telling them the story that explains the deal. Because the story is actually much more important than the deal. They want to hear basically what the general idea is. The numbers are important to some people, but most people just want to hear, well, I'm buying it at this price, and I think once I do X, Y, and Z, it's going to be worth this price. They want to hear that there's that kind of strategy in place, and they want to believe that you're the right operator for it. So it's about getting people that like you, and it's the know, like, and trust stuff that everyone talks about, right? They have to know who you are, they have to like you, and they have to trust that you know what you're doing. If you can accomplish that, then raising money actually becomes pretty easy. And but again, it comes down to the same strategy as negotiating, and that is presenting it in a way that when they look at it, they can say, yeah, this makes sense to me. I understand it, and I get what I'm going to get and why it's a good deal for me. And if you can do that, you can make a tremendous amount of money, because you can go find good deals, negotiate good deals, and then you can negotiate a good deal for your investors that works really well for you as well.
What would a typical structure for something like that be? Can you kind of walk us through, like, it doesn't have to be an actual deal, but like, how would I make it a win-win for everybody? Meaning I'm the guy that found the deal, but maybe I don't have the capital to actually buy it. How would I go about maybe structuring a deal with somebody?
Yeah, so of course it depends on the size of the deal, and what the structure is going to be. But if you're doing like a huge deal and you're going to raise a bunch of money from a bunch of different people, then you're really in the securities world, and you need to get securities attorneys to help you with structuring it and everything. And then you can look at, if you're going to give a pref rate or a waterfall or whatever. There's all sorts of complicated issues, but I don't play in that market very much. We do a lot more joint venture type stuff, so where somebody might put in more of the money, but everyone's an active participant in the deal. And we've structured those all sorts of ways. One thing I really like doing is something that we call it sideways aid investing, but it's like, that's the infinity symbol, so we don't put any of our own money and we're going to get an infinite return. But like, I might say to you, hey, I have this deal, let's go form a company together. You and I are going to be 50-50 partners. You're going to then loan the money to pay the down payment to the company, and the company's going to sign a note to you and pay you 6% interest. And then we're going to go buy this deal with the money, and we're going to split it up. And, that's going to be the whole deal. If I just say it like that, it's like, well, why would I do that? Well, the answer is, if you're a doctor or a lawyer and you don't have time to go out and find deals, and I happen to have a good deal, and you trust me to do a little bit more of the day-to-day management and make sure that your money's taken care of, and you're going to get interest on your money plus equity, it's kind of a pretty good deal. Like, if you have money sitting in a bank that you don't have anything to do with, and it's making 0.1% or whatever, and I'm telling you, I'm going to give you 6% down the road, you're going to probably get refinanced out. You're still going to own half of the deal, but you're going to have been paid off. And, it's a really great play for them because they can get interest on the front side. And initially that deal might only cash flow 7 or 8% on the money. So maybe they get almost all the cash flow at the beginning, but as I perform in that hypothetical scenario over time, we're going to have more and more cash flow to divide up, and I'm going to get my share of that. And then eventually we're going to refinance, and we're just going to be splitting it down the road. And you and I are both going to be happy, because I got into a deal I couldn't have necessarily afforded, and you got a deal you wouldn't have gotten otherwise. So
That everybody has something different to add. Now, what about like the commercial building, the one that you just got into? I know that you said that you're like diversifying a little bit. I know that some people are a little bit more concerned in the commercial space than there are in the multi-unit space. Was there any concern in that with like commercial tenants, like restaurants, or was it not that type of building?
Yeah, so it's mostly shopping center. So it is a concern. So we had one tenant that was like a lighting center or whatever, and they pretty much got Amazonified. They're out.
Yeah.
So there's that concern. concern always, but we have a karate studio in there, and we have a Family Dollar, so like a local grocery store kind of thing. And those things they're not going anywhere. I mean, they might open a different location and leave my location or whatever, but like in general, I don't think you can't really Amazonify a karate studio or a doctor's office. There's one of those in there. And there's actually a church in there too. It's another one. I mean, I guess you could do Zoom services or whatever, but people like to go and hang out with other people and commune with them or whatever they're doing in that particular church. And so I felt really comfortable with the tenant profile there. And I really, really like the area, that's another, important thing. Like, retail space is a lot different than residential space. Unlike residential space, the value from the retail space comes from the surrounding area because most of it's walk up or passing by traffic. People don't go to, they don't drive 30 miles out of the way to go to their local grocery store, but they will do that for their apartment. Sometimes people live 20 miles, 30 miles away from wherever they work, and it's fine because what they're producing economically does not come from their apartment. So, if the apartment's more attractive, it can draw in people that can afford to pay it. But with retail space, you really have to think about what's around it, what's the surrounding area like. In this particular area, there's a lot of economic growth. They put in a $10 million complex right across the street, and they were renovating the building next door, and they're renovating the one on the other side. And I kind of went, yeah, this looks like a good place to be. It's sort of on the upswing. So I feel pretty comfortable with it.
And then is there a value add strategy for that as well too? Or is that more of just, hey, look?
That was more of a, we had a pretty big capital gain to offset, and it was, we could have bought some deals that I think would have cash flowed less well in the residential world. And I felt pretty comfortable with this particular deal. A friend of mine was managing it at the time, so I was comfortable with the numbers. His property management company assured me that what we were seeing was real. And I kind of went, this seems like a relatively low risk place to park some money, put a little bit more down on it than what we would have if we weren't 1031ing in. So it cash flows super, super well. And it's really, really easy to deal with, right? So that's another thing. It takes a little bit of effort out of the equation.
What about the rest of your portfolio, like the multi-unit? Like, how do you go about managing your buildings? And what are some do's and don'ts?
Yeah, so I don't manage them myself anymore. I did used to manage some of the single families and duplexes, but I have partners that are in almost all of my residential stuff. I have a partner who actually owns a property management company. So I have my partner in Michigan owns a property management company. My partner down here owns a property management company. So I let them handle the management side a lot more. But I do have some insight on that, and that is make sure that if you're hiring third-party property management, that you trust them, that they are complying with the law, because the law really matters here, right? Like what you don't want to do is create some kind of like fair housing claims or, any of that kind of stuff. And you also don't want to get stuck in a situation where you're not properly screening tenants and you get tenants that are there that are trashing your place and they're stuck forever and you can't get rid of them, especially, in COVID world, like, you could have been stuck with someone for, 18 months without being able to get them out of the place and they're not paying rent. So we're in a situation where good management really, really does matter. And so, that's, to me, if you're not managing it yourself, you better make sure you have good management that you really trust.
What did the day-to-day look like when you got started in real estate investing versus maybe now?
Yeah, so when I first started, I was working a full-time job, so I didn't do a lot of day-to-day stuff, right? I mean, it was after hours or whatever, and I was investing from Tennessee in Michigan, and so my partner in Michigan did most of the hands-on stuff. So it really wasn't that much, and my role back then was not all that different than what I do now, which was helping put the deals together. That was, like I said, I'm pretty good at explaining to people why it makes sense to us and them. If you can do that, you can put deals together that other people can't. I mean, this 42 unit that we bought, we just closed on it about 2 weeks ago. There was a lot of problems with the deal. And it took a lot of effort to get the banks to go along, to get the seller to go along, to get the agents to go along. But by having enough conference calls and really, sorting through some of those issues, we were able to get a deal done that in the end, we only had to put about $200,000 of our own money in a deal that's about a $3 million deal, and had prepayment penalties, and the seller carried back a second, and the bank covered some of that, the refinance position covered that, and we paid a little bit more than we might have. In other words, we had a complicated negotiation that's essentially where I cut my teeth. I mean, that's what I do. So that's essentially the same thing I'm doing now. I will admit, I spend a lot more time networking now than I used to. I don't have a full-time job, so I try to make it a point to have lunch with someone almost every single day in the real estate world. And if I can't, then I'm having coffee or breakfast or something with them. I mean, to me, it's all about building relationships.
Relationships with who? Like, are we talking about like relationships with like commercial brokers? We're talking about relationships with property managers. Are we talking about relationships with other attorneys? What would you say, just to give our viewers a little bit more context?
Yeah, I mean, honestly, it's all of that. So investors is a thing I do a lot of meetings with now, or potential investors, people that might invest in our stuff, but also other investors that are doing the same kinds of stuff as us, because you never know when you're going to work with someone or they're going to have a deal that they look at it and go, this isn't right for me, but it might be right for Jeff. So I'm going to pass it along. Brokers, that's a big one. I mean, getting to know and having good relationships with brokers is important. Bankers is another one that's super important too. So I try to constantly be reaching out to all of those groups. And the good part about having all those groups is there's always somebody that you can network with somewhere. So I'm going to lots of real estate meetups and small business meetups and whatever I can to like meet other people that are doing things that I might need at some point.
Was there ever a time that you felt like giving up? You're like, man, like maybe like something that you went through where maybe things weren't going as planned, or?
Yeah, I mean, not since I really got serious about investing. I mean, I think when I was sick, and I thought I was dying, there was times where I was like, this isn't going to work. Like, I mean, when I was first diagnosed with leukemia, it was in September of 08, and I didn't think I was going to live till Christmas. I mean, that's where we were. So at that point, yeah, there was a temptation to just say, this isn't worth it. I'm going to give up and just, maybe go on vacation for the next 2 months and then die. But I've always been pretty optimistic about the future. And so I didn't do that. I'm glad I didn't. I just kept moving forward, and I'm glad I did. Honestly, in retrospect, that's probably the best thing that happened to me, because I haven't practiced law in years. Not that I dislike practicing law, but I mean, I just love what I do now. And I'm able to do things that I would never have been able to do as a full-time attorney. Like last year, right before COVID, I climbed Mount Kilimanjaro, took a month off, went to Africa. This year, I spent over a month in Puerto Rico already. In fact, I'm moving there. Like, that's a thing. Like, I just signed a lease yesterday, literally. So I'm going to be trying to move there. I'm probably 6 months away from actually moving there full time, but we're in the process of doing that sort of thing. And yeah, I mean, this just gives you a lot more freedom, and so I love it.
Is the reason for moving to Puerto Rico part tax strategy as well too? Because I know a lot of friends out there.
I mean, people keep asking me that, and the thing is, like, maybe, I don't know. I mean, I don't pay tax now. Like I said, I do cost segs and 1031, so I haven't had a lot of tax issues. But I do look forward to the future and say, these cost segs are a two-edged sword. They lower your basis if you eventually sell. You recognize some significant capital gains and recapture taxes. So I do think about that, but I don't even know if I'm going to take them up on the tax incentives. In order to do it in Puerto Rico, you actually have to apply for it. It's not automatic. And there's some compliance costs associated with it. So maybe I will, maybe I won't. It's going to depend a little bit on how much money I make there, because that's the other thing about it is it doesn't affect your US based income. It's only income earned in Puerto Rico that gets subject to Puerto Rican tax. So if you're a Bitcoin billionaire, it makes a lot of sense to move to Puerto Rico for tax reasons. But unfortunately, I didn't buy very much Bitcoin. And the little tiny bit I did, I sold when I doubled my money, because I'm an idiot, apparently. I think I had like $100 invested in Bitcoin back in the day. And that was like, I don't know, 3 or 4 Bitcoin at the time. I got up to like $200, and I'm like, woo, doubled my money. So oops, whatever, you only live once or whatever. So, and I have a little bit of crypto, so I can't really complain, but I really missed the boat on that one. I could have made a lot more money if I just stuck in that market.
What about your last life philosophy? What is that?
Yeah, I mean, that stems out of getting sick and recognizing that, we really are living, well, 2 things. One, you can't count on your life. So part of the last life ever philosophy is really saying, hey, if there's something I want to do, I need to do that. Right. I need to do it now. I can't wait for it. There is sort of a fatalistic kind of approach to it. It's also about recognizing that we're each unique, and we each have, this one time to go around, and whatever we do this time is the only impact we're ever going to have on generations to come. And so I feel like we owe it to the world. I mean, really, we owe it to ourselves first, and then our families, and then our communities, and then the world, to just go out and do like big things and live the best possible version of our life, whatever that is for us. For some people, it's completely different than others. For some people, it's just being a really good father, a really good mother. For other people, it's winning Olympic gold medals and like, leaving an impact that way, and utilizing the fame they get from that to raise money for charity or whatever it is. It's really stemmed from me getting sick and recognizing I have this uniqueness about me that I can share with people. And if I'm not sharing it and then I die, it goes away and it's gone forever. And I didn't want that to happen. I think it's important to share your light with the world. I mean, we all have unique values. We have unique things about us that benefit the world. And the more we give, it turns out the more we get back too. I mean, the world tends to reward value. So if you provide value wherever you go, it seems like you just get more value back all the time. And for me, it's also about not having bad days. That's another part of it. I have this thing where when I was 17, I gave up bad days. Most people think that's weird or impossible, but it's actually really weird to me that people have bad days, because they kind of suck and like they're not that hard to give up. You just kind of tell yourself today's a good day enough times, and that affirmation sort of trains your brain into this world where you see positive everywhere. So I got diagnosed with leukemia, and I went, man, I'm glad I got diagnosed late in the day. Most of the day was pretty good, and then later, the next day, it was like there was a shift change at the hospital, and the nurse that came in was actually one of my childhood babysitters, and I hadn't seen her in a decade or two. And she walked in and she goes, "Oh my God, Jeff, I'm so sorry to see you." And I just went, "Oh my God, Shelly, I'm so happy to see you." I was like, this is so positive. I get to see one of my favorite babysitters from my childhood. That was enough to outweigh the fact that I was likely dying. And if I didn't look at it that way, I may have died. If you don't stay positive and optimistic about the future, it matters. And so while that day was a hard day, and some days are harder than others, good and bad stuff's going to happen to everyone no matter what, I looked at it as a positive day at the time. And then in retrospect, it's I wouldn't be where I am now if I didn't go through that. So it's probably the most positive of all the days I've lived through.
What would you say is your motivation to kind of to keep going, or like your life purpose? What would you say?
Yeah, so I think about that a lot. I mean, it really is about sharing the last life ever philosophy. It's more important than the real estate stuff or anything. In fact, everything I do sort of synergizes into that. It's like I want to help people understand that they have to go after their life purpose. So it's almost like my life purpose is helping other people's find their life purpose. And the way you do that is there's no way I can ever go, okay, I know what your life purpose is, because it's something that's deep inside of you. But what I can do is I can encourage you to be searching for that. And, you might have more than one life purpose. It might be for a while, something's very fulfilling to you, and then something changes. Raising your children is super, super important to you and fulfilling for 18 years, 20 years while your kids are young and growing. And then later in life, you have to find something else to fulfill that need to give back. It might be your grandchildren, but it also could be like, volunteering or joining the Peace Corps or something. It doesn't really matter what it is. It's just that you have to be doing the things that you're called to do that feel right to you. And if you do those things, generally, there are probably exceptions. So I don't want to be too general on it, but if you do those things, you're usually benefiting the world. And that's sort of the thing that in the long run, that matters more than almost anything else.
Any final thoughts for our viewers, Jeff?
Just don't wait. I mean, we just don't know. You can't bank on your health. You might get sick. You might get leukemia. You might get hit by a bus or a meteor or whatever it is. So if there is something that you really want to do and you feel compelled to do, you should go figure out how to do it. People say, well, aren't you afraid it's risky to invest in real estate? And the answer is, yeah, it's risky to do everything in life. Life is risky, but what's the most risky thing is not trying to do the things that you want to do. Because if you don't try, you're definitely not going to get whatever it is that your dream life is.
Great. Well, I've enjoyed this conversation. I want to say thank you so much for being on the podcast. For all of our viewers out there, this was episode number 87 of the Morales Group Show. Last thing, if people want to find you, where do they go about finding you?
Yeah, sure. I mean, so I'm all over the place. If they just Google Jeffrey Holst, they'll probably find me. But at Jeffrey Holst on Instagram is good. Or if they want more about Last Life Ever, they can go in the Last Life Ever Facebook group. So it's Last Life Ever private group on Facebook. Those are probably the two best places to find me.
That's awesome. Well, thank you again. Once again, episode number 87 of the Morales Group Show. If you've enjoyed this interview, make sure to hit that subscribe button. And if you have any suggestions for us, make sure to comment down below. Thank you, Jeff. I really appreciate you.
Thank you.